Thank you very much. Thanks to all of you for joining today. I'm going to talk give the presentation focused in on all the macro impacts, and then leave it open for plenty of time for questions. You know a lot about these dynamics, and I want to make sure to address some of the things most relevant for you. I'm going to share my screen. Policymakers in the U.S., Canada, and around the world in mapping some of these risks, but also with investors who are trying to think about the different scenarios. We're going to focus today on the BRIC economies, but I want to put them in context of how the global economy is doing, and especially how emerging market economies are doing. As I'm sure you know from your work in the business school and elsewhere, the BRICS have commonalities, but also have a lot of differences. You have several commodity-rich countries, Brazil and Russia in particular, but you also have major commodity importers and buyers, India and China, and a country like South Africa that's somewhere in the middle. So I think you capture the microcosm of big, liquid emerging markets. And of course, with China, very much not only an epicenter of the economic impacts of COVID-19, because they were the epicenter and the first country that shut down, but also major driver of global demand. So if I wanted you to sort of take away anything from this presentation, it's to sort of highlight that what we're experiencing right now is very much a policy-driven slowdown that is likely to involve a sharper economic pain than the global recession, particularly for emerging market economies. And that reflects not only the fact that there was a policy decision to shut down many parts of the global economy, but also that some of the fiscal and other buffers in emerging markets were actually used up in over the last decade and in the global financial crisis. So to some extent, the growth buffers, the financial buffers are less available. Other trends that I would see being quite relevant and actually reinforced by this crisis, and of course it's probably three crises. There's a health crisis, there is an economic crisis, global recession, and there's a financing crisis. That is all arguably amplified by the oil and energy crisis. And we can talk a little bit more about whether there are any winners out of that oil and energy crisis. A country like India, that of course is a net importer of oil and gas. I tend to think there aren't a lot of big winners because there's a hit to financial markets. But let's move on to the show and some of the slides. So I will advance along. I guess the final thing I should say about myself is, in addition to working with investors, my work with some think tanks in Washington D.C. and in New York leaves me spending a little too much time thinking about U.S. trade policy, investment restrictions, and powers that countries are using more generally. So if we think about the economic impacts of COVID-19, we start with a dynamic where, we start, when we look at some of the early economic data, what we see is a sharp drop in output, but it's particularly sharp drop in sentiment and activity on the service side. There are definitely outages on the manufacturing side, but this is very much a demand drop, an engineered demand drop, right? When have so many people across the global economy been asked to stay home, to not go to work, to perhaps not get a paycheck, but still have the dynamics? Now, this is somewhat unique because some of the past recessions that we've seen, especially globally, have been more manufacturing driven. If we go back to January, when many of us started thinking about the economic impacts of this, of this crisis, many economists focused in on the fact that there would be supply shortages coming out of China, that factories would be shut down, and people reliant on input and goods would not have those inputs. What's become clear is that even in China, which we think of as a major industrial power and services were quite painful, were affected. Is significant is also that this came after a year 2019 where manufacturing was already a bit weak across the global economy. There was a slowdown in China and parts of Asia. There was a very big there was a noticeable slowdown in Europe, and so parts of the global economy were only starting to recover. So what I've shown here on these slides are the Purchasing Managers Index. PMIs have a number of challenges with them, but they are some of the fastest released economic sentiment indicators. I recognize some of you may be familiar with these data, some of you may be less familiar, but these purchasing manager indices, they show a change in the rate of output, new orders, and generally sentiment in services and manufacturing. And so what you see across the globe in the data we have sort of through April for some countries is sharp drops across the global economy. And the data series I have shown here doesn't go back to the global financial crisis, but for many parts of the global economy on the services side, it's much weaker than the comparable results in the global financial crisis. We do see a sign that on the Chinese side, there's a move up. There is a bit, which is a bottoming out, right? For the PMI report, or a registered number of 45, which was what we have here, just means that it was contracting less at that point, not that it was an outright rebound. On the manufacturing side, the story is a bit more mixed. As you see, for some countries, I'm not quite, especially Australia seems to be a very volatile place. You have a flatter sort of dynamic, and you also have, but again, you have this sharp drop in China and then a bottoming out about a month later. For some of the other countries, we haven't yet seen that bottoming out. So more broadly, I think if you look across many major economies, you see a dynamic where retail sales, global consumption will have experienced this weakness. In the upper right-hand corner, we have Chinese retail sales. They fell sharply. Many around the world, there's also been a shift in what people are buying. So they're buying less, but they're buying more basic food and other things they need to survive, and they're buying less of other discretionary consumer goods. And so that's meant that places like grocery stores and other essential businesses have been a bit better off. Now, they too have faced some supply chain issues, and then we can come back to that. But as I say, what's unique perhaps about this set of episodes is not only is production down, but consumer demand, particularly for services like travel and tourism, hospitality, is down even more than other dynamics, and that's definitely the case across many of the large emerging markets as well as in developed economies. Another major aspect has been capital flight. Typically in a crisis that has a financial element, we have flight out of higher risk assets, including many emerging markets. What's unique about this is that the scale and speed of capital outflows from emerging markets was much more extensive the global financial crisis, or it happened much more quickly, perhaps, is maybe what's the important part. But then it's also a more extreme capital outflow than during the taper tantrum, when investors were worried that the Federal Reserve would hike rates quickly. or the slowdown in economic growth in 2015 that was triggered in part by the Chinese currency, sort of currency adjustment. Now, the impact of this capital flight, which has been more concentrated, which has been concentrated in both debt and equity across emerging markets, has, if anything, reinforced some of the challenge on policy space that these countries have experienced. Now, not all emerging markets have suffered as much from this capital flight. In fact, while China experienced capital outflows in January and into February, there's actually been net inflows in March and April, and the Chinese currency has stabilized and has been flat for the year. Other countries, including surplus countries, have been a bit more resilient. Even countries like India, where you've seen significant pressure on the rupee, but you actually have a higher domestic share of holdings of Indian government bonds and other dynamics, have provided a bit of solace. And of course, as we alluded to, having to pay less for oil imports is maybe a rare silver lining. It may not compensate for all the other challenges. So on the right-hand side, I've pulled up the reliance of a series of emerging markets, their reliance on foreign investors to hold their local currency debt. Why have I focused on local currency debt? To underscore the fact that this is some of the debt and financial issues are not just a function of dollar debt, but are also a function of whether the local currency debt relies on foreign buyers, because foreign buyers may experience a broad flight to safety or flight to liquidity, perhaps, as we've seen in this episode. And so this is highlighting some of the countries that are a bit more exposed. Places like Peru, places like South Africa, places like Turkey that, as you can see, have already experienced a lot of capital outflows, places like Mexico and Indonesia. And it's perhaps not as much surprise that some of these countries, their central banks might be a little more exposed. Now, not all countries have reported data for this quarter or the last quarter yet, so not all of them have been updated. But it gives you a sense of where some of the vulnerabilities might lie. So that's another aspect of the economic strain. At the same time, we were looking at, on the left-hand side, we were looking at both flight out of government bonds, but also in some cases corporate equity and corporate debt. That in many countries reinforced demand for U.S. dollar assets and liquidity needs. And one of the dynamics that has been unprecedented has been the number of countries that have faced meaningful liquidity needs. Over 100 IMF members requested short-term financing from the International Monetary Fund. Maybe a little bit less than half of that have received funds to date. The IMF doesn't move incredibly fast, but they're trying. And this chart I pulled up here comes from the website pulled out today, or actually yesterday, that shows the countries that have received funding. What you see here is that they have focused in on providing rapid financing, that's the green and the red, or other measures to developing to some of the poorest countries. It's not to say that some larger companies haven't also asked for money, and more will sort of do so, but the focus has been on highly indebted poor countries. At the same time, about 2 weeks ago, at the annual meetings of the spring meetings of the IMF and Monetary Fund, the members of the G20 agreed to suspend debt payments from all the countries that owed them money. That is relatively unprecedented, though of course they're not canceling that debt. They're just saying that just like a landlord might, well, you can have a little more time to pay. But what we're talking about here in this broader context is the difficulty in assessing what are the countries and companies that maybe just have liquidity issues and what are the ones that have solvency issues. If you're running out of cash, you can you can create a solvency issue. The point of policies like this are try to avoid this outcome. And in fact, the impact and goal of a wide range of the policy decisions underway around the world has been to try to provide some solace so that individuals and companies can survive to such a point that the economy is recovered. As I'm sure you well know, some countries are more able to provide those funds. But, I mean, we've told a pretty negative story here to date. I think it's important to remember that actually some emerging market economies have regained market access or have gone to the market, including even some of the ones that I highlighted as vulnerable a few slides ago. Countries like Indonesia, Mexico, even many oil producers that are facing the challenges, they have gone to the market and it's been oversubscribed. Now, I think this raises a couple of important points to me. One, there's arguably a distinction between countries that are higher rated and those that are already in junk status. And that the financial crisis might reinforce those divides. Number two, I think is something to watch, that countries might be going back to a preference for dollar debt financing as opposed to local financing. Borrowing in dollars is not always a bad thing if you can borrow cheaply, but it can constrain the monetary policy space that countries have, and particularly in times where and currency space that they have. So that I would say is something to watch. In general, across the emerging world, you had actually not seen a major increase in dollar and euro denominated debt, and so emerging markets were starting to issue more in their own currencies. So Indonesia issuing $4.3 billion, that doesn't get to an unsustainable debt burden, but it is something to watch. So a further source of financing challenges is remittances. Remittances already in 2018 and 2019 outstripped foreign direct investment as a source of financing to emerging and developing countries. Now, not all emerging markets receive sizable remittances. I've shown on the right-hand side the countries that are most reliant on remittances. Most of these you'll see are very poor developing economies, including several in South Asia, but also countries like the Philippines and Egypt, other big emerging markets reliant on remittances, or where they make an important role, might include Mexico, but it's less than 5% of GDP, and even India, where it's a bit less than 3% of GDP. These trends are likely to, impact different segments of the economy. Remittances tend to be a lifeline for consumption as people go and work abroad and send the funds back to their family members at home. They also tend to be a capital source for construction of residential buildings. So the loss there tends to have a disproportionate impact on parts of a country. On the left-hand side, I've pulled out the countries that are the major sources of remittances, the sending countries. They include the United States, they include a number of oil-producing countries, most of the Gulf countries, as well as Russia, and then a number of European countries and other developed economies. What, sort of the takeaway here, and this is data from definitely more than a year ago, even though it was published 2 weeks ago by the World Bank, but these are a number of countries that are likely to have less earnings for these migrant workers that are working there. We know that the COVID crisis may well reinforce the trend towards more restrictions on foreign workers in select places across the Gulf cooperation countries like the UAE, Saudi Arabia, Kuwait, Qatar, and Oman. The crisis is likely to reinforce the preference for locals, for citizens to have greater, more work and more income, and so this is going to be a dynamic likely where these flows are going to be weaker. But to the extent they show up on this list, BRICS economies tend to have other sources of financing. So this is a systemic issue for them, like it is for some of the smaller countries in Central America and South Asia and Central Asia. But it's still something to watch as a source of concern and relevant within some subnational areas. I mentioned a little bit earlier the currency depreciation that emerging markets experienced. What we've seen is pressure on most emerging market currencies, but there's been a real divergence and differentiation. Commodity-rich countries that are big liquid markets like South Africa, Brazil, Mexico, Russia, those have faced very extensive currency depreciation. In part, these are countries that are allowing the currency depreciation to be a bit of a buffer and lifeline for some of the adjustments. So rather than drawing down all their financial assets, they are allowing the currency to adjust. That in turn, though, of course, raises the cost of import. It likely reinforces demand weakness and will likely lead to a forced improvement in the external balance. That tends to be bad for local growth and global growth. You'll see, of course, that some of the countries a little more resilient on the currency side that haven't faced as many pressures include some of the Asian countries, including some surplus countries, but also India, right, which might have a fiscal deficit, but and twin deficits, but is improved by the oil, the cheaper oil financing, but also has somewhat more domestic finance via bank purchases of sovereign debt and the like. So there are limitations. Sorry, we have a blank page. My apologies for that. What I pulled out here is one attempt to look at how countries have responded to this extreme economic shock that they've faced. Across the G20, we have seen most countries respond with some sort of fiscal stimulus. Even more of them have done monetary stimulus and credit stimulus. What I think has been a bit unique in this crisis has been the fact that across many emerging and some more developed frontier markets, there was significant credit enhancements, loan forbearance, and other policies used to try to keep the banking system running, to keep the banks providing capital to small and medium-sized enterprises and the like. Now that can only go so far, right? The banks, even if they're more solid than in the global financial crisis, can only do so much, and same thing with the central bank. Now, one of the big challenges that we keep coming back to is a question of how much policy space emerging market economies have, including the BRICS, and how much they are self-imposed in their perception of how much policy space they have. Now, I noted that emerging markets are not coming into this with big fiscal surpluses. One of the few countries maybe that has big fiscal surpluses in the last few years has been Russia, and that's largely been because they were they were trying to make their economy as strong as they could so that the impact of economic sanctions imposed by the United States would be less extensive. But across the board, we have seen somewhat weaker revenues and greater spending needs. So perhaps it's not surprising that a number of emerging markets have so far rolled out smaller fiscal stimuluses in this crisis than in 2008-9. So for some countries, they're only just starting to work on that. For other countries, they are trying to do the challenging act of repurposing money that was already allocated for different purposes. But there is this open question whether emerging markets will be given the benefit of the doubt by financial markets to do large stimulus packages in the way that some of their developed market peers are. And so far, I think we've seen many emerging markets err on the side of caution. I think that the pendulum is probably going to shift the other way, but we can talk a little bit country by country for those dynamics. Ultimately, I think the takeaway from several crises of the past decade, which is to highlight that cutting government spending, going into a recession, or on the way out of a recession, doesn't help the fiscal outlook very much because it actually increases rather than decreases the amount of adjustment that's needed. Because cutting government spending hits domestic demand, hits and actually makes the challenge greater. But let's move along because I want to make sure that we have time to talk about some of these dynamics. So turning now to monetary policy, the other pillar of the policies we've just been talking about, and maybe the one in which there has been more policy space taken and more policy space present. So on the right-hand side, I've pulled up a select set of emerging market central banks, how much monetary easing they have done. I focused in on rate cuts and how much they have fallen and where the policy rate is today. In many cases, the COVID crisis either allowed countries to continue easing, which they had maybe stopped, but in some other cases, there might be limited additional room. On the left-hand side, I've pulled up some estimates of the real policy rates as of approximately today. The inflation data lags a bit. Obviously, the policy rate numbers don't. And so what we're seeing here is a real divergence between some of the countries, some in Asia and the like, but the few countries that still have positive real policy rates adjusted for inflation, but a general trend that's sort of quite unique of significantly negative real interest rates. Historically, countries would be worried about not only the impact on currencies, but what it might mean for future inflation. Personally, I'm less worried about inflationary pressures at a global level and in many of these countries. Why? Because we've had a hit to wages and to employment and we're also not seeing a lot of credit growth. But we can, of course, talk about inflationary risks in the question and answer session if you have discussions on that. Before we turn to the Q&A, I want to, I'm actually going to stop sharing my screen. I want to sort of highlight a couple important trends to watch. One critical trend has been refers to trade and investment restriction. We know the last few years have been the years of the trade wars, particularly between the United States and many of its trading partners, perhaps most publicly China, but it's far from only about China. They've also been a point of greater investment restrictions. One broader trend that we've seen is just sort of going into the COVID crisis, despite having a phase one trade deal, tariffs between the United States and China remained much higher and therefore much more protectionist than they had been going into the trade war. There hadn't been much reduction. And if anything, there was much more comfort level with government involvement in sourcing goods, providing sort of raw materials and the like. In the response to the COVID-19 crisis, we've seen over 80 countries impose maybe short-term restrictions on key medical supplies. Some of them have been lifted, but we've seen a preference of using export controls. We've also seen countries ranging from India to Brazil, to Canada, to Australia, to Germany, increase their their scrutiny of investments to be worried about whether foreign investors, including Chinese government companies, might swoop in to buy some of their assets. That, I think, is a trend to watch, and one that might persist beyond this crisis. Many of these trends could be done quickly because there already was sort of such a policy measure. More generally, if we look at the oil market, we're also seeing a wider range of countries be much more comfortable with government involvement in regulating supply, regulating consumer trends, and the like. I think it may be quite difficult to adjust those dynamics. So I think watching those. A final point, I guess, I'd like to end on, which is an importance in thinking about changes in supply chains and the like. This ties into the theme on trade. On the supply chain side, we've seen out of this crisis, partly because of export controls, partly because of restrictions, a greater push and rhetorical push towards using a greater push towards at least rhetoric around deepening local supply chains. For some countries, there was already this rhetoric. You are probably even more familiar than I am with the Make in India policies and have your own views about how that's played out. But there's definitely been among larger continental economies, this desire to deepen their own supply chains, not necessarily in an efficient manner, but there are other sort of benefits. What I see happening, localization, especially among countries like the United States, and more restrictions on trade. I think this is a dynamic that could be quite problematic for some of the emerging markets that are reliant on those channels. Now, is the United States going to stop importing? No. Are some of the major emerging markets we're talking about going to stop importing or produce all their goods at home? No, probably not. But I do think we will see companies looking to build in redundancy into their supply chains, try to have alternate ways of sourcing. And that, I think, raises some interesting questions for countries like Vietnam. That's maybe been one of the relative winners out of the US-China trade war, and some of the other investment dynamics, because they might face some other scrutiny. I'm going to stop here because you've all been very patient and listened to me for the last 40 or so minutes, and I'd be delighted to take your questions. And please also feel free to share some of your thoughts or to disagree with some of the points that I've brought up. The nice thing about doing this is you can share with me some of what you're seeing. So let me stop there, and I'll hand it back over to the professor.
Just in case anybody has a question, please tap on the raise hand option so that we can unmute you and you'll be able to ask a question. Ma'am, there's a question in the chat section. It's by our director. If you could just go through that. Yeah, it is argued that COVID-19 is another stage for political rivalry that has reinforced some international disputes and conflicts with the US, particularly with China. So that's his question.
Yeah, I mean, I see the follow-up.
Yeah.
And just to sort of complete, because some of you may not see this, but what could be the implications? I think that's a great question, and I would agree. This sort of international geopolitical tensions have exacerbated the crisis and been exacerbated by it. So I think as I was highlighting, of course, there's COVID-19 came at a time when already the US and China, who were quite willing to use coercive economic policy on other countries, have been using it more on each other. So whether those are measures like using export controls to, on the US part, to try to limit the use of Huawei and Chinese technology, are forcing other countries to try to pick and choose, countries that have either been allies of one or the other. I tend to think that there is a real challenge there because there is not, partly because there's not really an alternative to some of those Chinese technological equipment. So I think the scenario in which, and I see the follow-up of how does this scenario, what does that mean for India? I think it's challenging. It's particularly challenging for India, which is a country that wants to have good relations with both countries and good relations with all trading partners and the financing environment. Greater tensions between the US and China, I think, contribute to weaker economic growth and more financing challenges. Another concern for a country like India that is so involved in key multilateral institutions and the like, is in an environment that, say, the United States is funding less institutions like the World Health Organization or some of the United Nations organizations. That's not great for a country. That's not great for a country like India and other emerging markets, particularly that is having to address those issues. Now, obviously, Modi and Trump have had some degree of bilateral talks, but I do think that creates the net result of this is not good for global growth and other dynamics. I also think it feeds into perhaps inward-looking policies in a range of other countries, including in India. So I think net it's a negative outcome, and that's where also the push towards investment restrictions and protectionist policy is not a great dynamic. The other thing I think relevant for India, which is not really a U.S.-China issue, but the dynamics present with the reduction in some of the developing countries' special factors in the World Trade Organization and the like, create additional obstacles. I know that we've got a couple more questions, so let me stop there. Should I read out the questions, or how do you want to handle it? Okay, why don't I? Okay, great. I just got a message. Okay, so the next question is whether the drop in oil prices could it actually benefit India when demand is shut down all over the world? Can any country get benefit out of such drop in oil prices, including India? So I tend to think that the drop in oil prices is more negative than positive. Why? This is a demand-driven drop. This is not a story of a supply of increased supply. This is a story that the global economy has shut off. It's has basically shuttered part of its output to try to deal with a health crisis. Now, the oil dynamics, of course, have been exacerbated by the fact Saudi Arabia and Russia, among others, added supply at the same time there was this demand drop, in part because they didn't expect there would be as much demand drop. So what we've experienced, so I think that has exacerbated the move. The other challenge, even for countries like India and other Asian countries that sell a lot of goods and provide labor to countries, oil-producing countries, is that you don't have that sort of service and goods export. Finally, one of the other challenges is India's almost already filled up its strategic petroleum reserve, right? There's not a lot of room to take advantage and store those additional supplies. So I think on net, it's not great. That being said, there will be there will be some support to the external balance that offsets some of the other challenges that India faces. But in this environment where Indian domestic energy demand is down, I think ultimately it's more negative, and we see that reflected. But the biggest pain, of course, is in the energy producing countries. The other thing, of course, I think relevant to India and some of the other South Asian countries is the challenge, particularly in the Gulf cooperation countries, of work. Next question is, what about the $5 trillion pledged by the G20 nations? Is that enough to kickstart the economy? So I think the money that the G20 has pledged definitely helps a lot. I think one thing that's quite important when we look at those numbers is to unpack how much are financial lifelines to try to keep businesses and people afloat, and how much is actually new spending. One thing I didn't talk quite as much about, but has been striking in this crisis, has been the relative caution and moderation of the Chinese policy response on the fiscal side. What we've experienced, and that reflects a couple of things. One, that the Chinese authorities are aware that they already had a fiscal deficit. Number two, that they wanted to wait and save their fiscal and credit support to a time when the economy was already reopening, right? They didn't want to just sort of throw liquidity out there and have an asset market boom, which of course to some extent is what's happening in the U.S. and other economies. But I do think ultimately, one of the challenges that is a challenge. The other issue, I think, comes back to the return on capital and the debt, and the debt dynamics. I don't think now is the time to be particularly worried about overall global debt levels, but the cost of financing, I think, is quite important. So I think when you look at the money pledged by the G20, you want to assess how much is actually new money, how much is just covering existing debts, because a lot of it is covering existing debts, and how much it will address some of the drivers of lower productivity. Moving on, there are
Ma'am, we have a few questions in the Q&A section as well.
Oh, great. Okay, great.
Almost
Oh,
6
sorry.
questions there, yeah.
Wonderful. And the other thing I'm happy to do for some of these. Okay, great. So in the Q&A section, what about China launching digital currency? How will that impact the U.S.? So, I mean, China right now, if anything, China's been quite ahead of the curve on moving to digital transactions. I say this as someone who normally lives in the U.S. The U.S. is quite slow in digital transactions on a relative basis. I know in India there's still a lot of sort of scope to go on digital transactions and the like, despite some of the efforts of the government. So I think one of the issues that present with the goal in some ways of the China launching digital currency reflects both Chinese authorities' desire to stamp out some of the cryptocurrency and other things present. The other dynamic and challenge that it poses for the U.S. is whether it will make it even harder to monitor risks and sanctions issues. At this point, I think given that this is a currency launched by the People's Bank of China, and the People's Bank of China continues to be worried about losing control of the currency outside the country, I'm less worried about that. But I would be watching greater use of new payment systems, for example, collaboration between China and Russia, that in part is desired to be sanctions busting. One implication, interestingly, of the very extensive stimulus from the Federal Reserve Bank the Federal Reserve Bank is that if anything, it was a reminder of the importance of the U.S. dollar and the U.S. Central Bank. So a couple of other questions which are sort of relating to how to spend on how to spend on economic development issues. How will political and workforce dynamics change? Some of that will remain to be seen. But I do think the challenge on the employment side means that we will see less migration for work. And that's, I think, going to pose a question. There are going to be two types of problems there, right? You have a set of countries that face the problem of, you have a set of countries that face a challenge that they have an aging population and not enough workers, and other countries that have a very large sort of workforce. I think that adds to political and social tensions. And then, of course, I think this is all happening in a backdrop of greater automation, which of course raises challenges. I know we're running out of time, so one of the last questions, I think I'm going to group together a few questions which are sort of around how India maybe should respond to China. Should they should India be restricting its trade relationship with China? Are there areas that India could benefit on the manufacturing side? What should be the result? So I think one of the challenges where India is concerned, its export apparatus is much more developed on the services side, on the business processing services and the like. Now, those are services that will do a bit better than tourism and retail and in-person services, I would argue. And India's alignment with some parts of the software and technology probably put it in a slightly better position than some other countries. I continue, there are obviously pockets of manufacturing that are more sound than others, but I know that there are quite some challenges in rolling out more manufacturing at a time when many countries would like to boost manufacturing. So even though I would see that manufacturing maybe is a little more resilient than services at a global level, I think there's still, a challenge there. I'm reluctant to recommend an across-the-board, say, trade restriction, like India restricting trade or investments. I think what's really important for any country is to identify what its development strategy is and to have a predictable policy towards investments and the like. In India, of course, some states have gone ahead and have tried out new and innovative things. And I think one of the things that could be quite important is sort of predictability there and continuing to reduce some of the red tape and the like. One, I think, positive thing, it only goes so far, but that India has done over the last several years is some of the work that the investment platform that sort of is looking to bring in sovereign wealth investments and the like has done to try to put some government skin in the game and address things in that way. I know that we're coming up to the hour. Maybe we should stop there, or should we do one more question?
Ma'am, of course, we can do one last question.
One of the reasons I think Chinese equities have been doing so well is that the prospect of reopening happened earlier, and investors started to price in that better outcome. More broadly, I think what I see when I look around developed market equities, I see that there's a bit of a disconnect between equity markets that are quite forward-looking and the real economy. Because for the real economy, I think will suffer more from bankruptcies and other credit events, whereas the equity markets, I think, are more driven by liquidity. That being said, those trends of over-optimism are less present in emerging market economies, in part because foreign investors have a degree of liquidity bias. Why don't we stop here? And, if there are follow-up questions, happy to take them. And it's been a delight to speak to you all today and hear the things you're doing. I would look forward to, hearing your views on India and the rest of the economy in the future.
Ma'am, it's been a delight to have you as well and for you to share such valuable insights. And that presentation was superb. I think the numbers are really, surprising, and the future is really, really uncertain. So I'm glad that, we had this seminar so that we could look a little into the future maybe and see where, all global economies are headed towards. It's been an honor to have you with us, ma'am, and we will surely plan something on similar lines again in the future.
It's my pleasure, and thank you very much. Have a good rest of the day.